Hey there, Ed McCormack here, founder of the crypto education platform, Dchained. Today's video, we're going to talk about one of the most controversial, one of the most hotly debated topics in all of cryptocurrency. One that gets people madder than a QAnon member at an Obama rally. We're talking about privacy and anonymity, and ultimately whether these two facets of blockchain will continue to exist as the industry moves closer and closer to widespread regulation. And we're going to cover all of that right now. So to take a step back, I just want to put a disclaimer that in this video, we're going to talk a little bit about two of the main forms of compliance that the financial industry has been following for years, and ultimately, crypto exchanges, protocols, wallet providers are moving towards. But in talking about that, I'm also going to introduce a few ways that people are maintaining their privacy and anonymity today. And in doing so, I am not endorsing any of these specific technologies, ways of staying anonymous, or if they're used for illicit activities. I'm simply just mentioning how people are keeping their privacy. So without any further ado, let's talk a little bit about the idea of privacy and anonymity. And when you think about really the origins of blockchain, this was really built into it. It was a way for people, regardless of where you lived, your socioeconomic background, to be able to transact with people around the world in a decentralized manner without having to provide a wealth of personal information about yourself. And the reason that blockchain has started to be looked at as a potential fix and solution for today's world is it helps solve three big problems. One is accessibility. So when you think about most KYC, which is know your customer, and anti-money laundering, which is really focused in on understanding where the source of your funds come from. When banks and financial institutions undergo both compliance checks, they're requiring that you have some proof of identification. And for the most part, people who are watching this video, investing in crypto, have just that. But the fact is that over 1 billion people worldwide don't have any form of identification. And it becomes incredibly difficult to be able to pinpoint information on that person, where they're from, where they're born, and ultimately starts to create a disparity between the people who have the means and sort of are in this advanced path in society and those who are not. And the fact is not only is that a humanity issue, but it's one that we could solve pretty easy, because if you look at the overall trend among big areas with populations who don't have access to identification, many of them own cell phones. And that is where a solution across the blockchain could come in handy, where you can have a digital identifier. And there are a number of projects out there, whether you're talking about IBM all the way through Ontology, who has OntID, all ways to be able to store your identity on the blockchain in a very secure manner, and then use that across platforms, across sites, what have you. So it solves a really big issue that we have today, which is a lot of people around the world simply just don't have access to IDs. The second issue is related to security. And if you think about your daily life, as you move throughout your day, you are leaving breadcrumbs of data about you everywhere you go. Whether it's you have your phone on you and your apps are following your movement and location, which inevitably tells me if I'm a burglar that you're not home when you're driving to work. It gives a lot of information away to people, and it creates these what's called honeypots for hackers to be able to find out enough information about you to access your accounts. Again, going back to the fact that many people will use the same password over and over and over again. But this problem is only going to compound more and more, especially as 5G connectivity continues to grow around the world and more devices that we own start to get connected to the internet. This becomes a massive security issue. And as we've seen, in recent years and even months past, whether it's, the Colonial Pipeline here in the US or instances of hacking that go on every day around the world. If there is a central server with a physical location that someone could pinpoint, you can assume it's going to get hacked sooner or later. So blockchain helps provide these very strong safeguards to someone's identification. And at the end of the day, your identification is really the face that you put out there to the world. And it's critical that you maintain and protect it, not only just in terms of the hassle it's going to create for you, but also so that you can ultimately, be able to access services and products a lot more easy, whether you're talking about a loan all the way down to, a job application. And then the last piece that this really helps solve is fraudulent activity. And this is ultimately something that many of us, don't really think about too much unless you're doing illicit activity, but it's an area that a lot of law enforcement around the world are taking upon themselves and also partnering with different consultancy groups to be able to map out where and who illicit activity is occurring. And this is something where on blockchain, it is quite easy to be able to identify individuals based on the activities that they're doing, because once you move off sophisticated technology, and we'll cover some of that technology in a moment, once you go from that back to a transactional blockchain, especially Bitcoin, and then even more so, you have to go through a gateway to cash it out, like a bank. Pretty easy for law enforcement to ultimately crack down and find you. So let's talk a little bit about privacy and the ways that people are using current technology to maintain their privacy. Now that we know ultimately that blockchain is a solution for identification purposes, there's got to be a fine balance between being able to be compliant, but also having enough protection where your consumer privacy is being kept intact. Otherwise, there's the overstep, that big brother scenario. And there are three ways that people are ultimately keeping their privacy. The first is through privacy coins. And you may have heard of Monero, which is certainly one of the largest privacy coins out there. And Monero is basically open, it's called open software for cryptocurrency that has enabled people to be able to trade based on this architecture that uses three main sort of components. One is it uses a technique called obfuscation, which simply means that you are taking a transaction and you are adding it to a whole bunch of other transactions to the point where it's very hard to pull one out from another. The other that they do is called zero proof knowledge. And zero proof knowledge is really a very shrewd technique where there's no actual information about a transaction that's being shared, except the person who actually made it has a secret code. Think of like a 20-digit alphanumeric number that they will share with the smart contract owner in order to unlock the funds. And only the person who knows that code would be able to share that with the contract owner. Throughout this process, though, there's actually no record of a transaction occurring anywhere on the blockchain. So it's direct communication with the contract holding those funds and then the code that unlocks it, that only one person would know. And then the last piece are what's called stealth addresses. And this is basically, just creating a series of new addresses that make it really difficult to pinpoint an individual as their funds move from one protocol to the next protocol. With that being said, there's also another more useful way, and I say useful because this is something that I think could have mainstream adoption. And this is where middleware comes into play. Now, middleware, is really the concept of being able to allow someone to facilitate a transaction without ever having to broadcast that transaction out there for onlookers on the blockchain. And this is something that, quite honestly, happens very often in the financial world. One of the biggest means of actually doing trading in the current stock market are through what's called dark pools. And this is just simply over-the-counter desks that focus in on doing large volume transactions for big banks, and Bloomberg, Morgan Stanley, Goldman Sachs are all involved. And ultimately, you make a transaction without having to signal to the market that this transaction is happening. And it's done so that these big banks, because of the size of their orders, don't get front run, and that they're getting the best rate possible. Now, that is essentially being replicated here in a process being done by a number of different platforms. One of my favorites, and I disclaimer, it's something that I own, it's called Raise Protocol. And how Raise works is through a 3-step process. First is minting. So you're going to take Bitcoin and you convert it into the Raise version of Bitcoin. So let's call it RBTC. The second step is you're going to be able to take that RBTC and transfer it to whoever you'd like so that they can then receive it. And then the third step is redemption. And once I receive it, I want to be able to now convert our BTC back to BTC so that you have that initial core digital asset that was really being intended to be sent over to you. And because there's a conversion to a different currency, and that converted currency is actually being used throughout the transaction, it becomes incredibly difficult to be able to identify what is happening by the involved parties. And this is something that is going to be very useful, especially as sensitive information is shared across the blockchain. If you have a health record that's being communicated, you probably want that to be in the most secure, most privacy-focused way possible. And this is where this middleware really comes in handy. And then the third option here is what are called mixers. And this was made very popular more recently by platforms such as Tornado Cash. And it works in a way similar to how Monero works in that it uses a technique called obfuscation. So I'm going to deposit money into Tornado Cash. Tornado Cash will then send my money to a smart contract that groups all the funds that have been deposited over a period of time. And then when it comes time to withdraw, I'm able to not only do that using that secret code, which is zero proof knowledge, but also to use this third really unique sort of capability that some of these mixers have, which is to actually now send that money through a service called a relayer. And what a relayer does is you have the option to withdraw those funds to a different wallet address than the one used to deposit. So if I'm going to use wallet A to deposit, but I want to withdraw and actually send that money to wallet B, even if wallet B has no money, no balance on it, it's fresh, you could do that. So it becomes incredibly difficult if I'm trying to track you and I see that you make a deposit to a smart contract and then nothing comes out back to that original wallet address. All of a sudden, there's a new address that wasn't being monitored that just got funded. Sounds incredibly technical, and it is, but the fact is that if you look at all three techniques, going from privacy coins down to middleware, down to mixers, the Achilles heel across all of them are humans. As unpredictable as the technology is able to create, and unpredictability as these platforms focus around, the fact is that humans are predictable. We follow patterns. It is very difficult to sort of act in a very eccentric way for a prolonged period of time before habits begin to form. And this is why over the last year, you've seen regulatory groups like the IRS come forward and offer up these bounties for consultancy groups to help them trace activity on these platforms. And this is why Chain Analysis and CipherTrace and some of these bigger firms have been successful in winning those contracts. So while there are ways today that we are keeping anonymous and keeping our privacy intact, the fact is whether you see what FTX is doing, where they're leaning in on compliancy, all the way to Aave, where they're creating their own permission liquidity pools for a big institutional, or these new projects, whether it's from a behemoth like IBM or companies like Ontology creating decentralized identification, we are moving in that direction as an industry. And to be honest, it's a really positive thing, because in order for this to start to get adopted, at the government level, at the business level, these organizations, these bodies are going to require that it follows the rule of law and that ultimately it's as transparent and compliant as possible. So these are all positive things. I know that that might be a bit argumentative for some of you that might feel very compelled by consumer privacy, but truthfully there's a way to keep both. But ultimately, the era of acting in the shadows and operating sort of in this pseudo post Silk Road world, it's come to an end. So on to bigger and better things. I hope you enjoyed this video. If you did, please subscribe to this channel and of course pound that like button. And do tell your friends and family. We are always looking to grow the Dchained community, and we really appreciate all the support from all the viewers. So until next time, happy and safe investing. I'll speak with you soon.